Novartis has spent years stripping away the bloat. They've moved away from a sprawling healthcare conglomerate to focus on one thing: innovative medicine. All that institutional weight is now concentrated in specialized areas: oncology, immunology, and cardiovascular health. With over $56 billion in trailing revenue, the company often appears to be a safe, sleepy haven for conservative capital. But that scale can be deceptive. Under the surface, pharmaceutical investing is a high-stakes treadmill where you have to run just to stay in place. Novartis occupies a complex space, straddling the line between defensive stability and aggressive growth. Because of the nature of drug development, the stock vibrates between acting like a stable utility and a high-risk growth play. Investors have to decide if they're buying a fortress of recurring healthcare revenue or a melting ice cube of expiring patents. To allocate capital safely here, you have to look at the specific mechanics of the pharmaceutical investment engine. The process begins with massive capital outlays. Billions in R&D spend flow directly into clinical trials, where the vast majority of projects eventually fail. For the drugs that survive, everything narrows down to a single regulatory checkpoint. In the U.S. market, the FDA holds the power to approve a drug for launch or end years of investment with a single decision. Success at this stage clears the way for patent exclusivity and a transition into a global, high-margin revenue stream. However, a single late-stage clinical failure can wipe out billions in expected future value. Current revenue is just the starting point. The real investment is in management's ability to navigate that brutal R&D treadmill successfully. The patent cliff is the structural danger hidden in the pharma model, tracking how long a company keeps its exclusive grip on a blockbuster drug. Right now, Novartis has several major drugs generating reliable, protected cash flow. But the moment that patent expires, generic competition arrives. Revenue for that specific drug doesn't just decline, it often collapses. This creates a constant race against time. In oncology, even if the patent holds, a rival's clinical breakthrough can make an existing treatment completely obsolete. A pharmaceutical giant must innovate fast enough to replace its disappearing revenue before the market notices. If the old blockbusters decay faster than the new drugs grow, the stock's valuation will inevitably contract to reflect that shrinking core. This cash generation power is why Novartis receives high marks for its dividend, currently sitting at an 8.5 out of 10. The mature drug sales from that investment engine are what fund these consistent shareholder returns. Since Novartis is a Swiss company, domestic investors trading NVSEF deal with an over-the-counter foreign security. This introduces Swiss withholding taxes, meaning your actual take-home yield is lower than the number you see on a stock screener. It's also a reminder that the dividend is only as safe as the pipeline. If clinical failures mount, the cash for these payouts eventually dries up. The dividend is a great secondary benefit, but it shouldn't distract you from analyzing the fundamental health of the broader drug portfolio. Determining if this stock fits your portfolio depends on which of three investor archetypes you fall into. For the income investor, the high cash generation scores make this a strong candidate for a cautious buy. Just be sure to individually verify the tax treatment and ex-dividend dates to ensure the math works for your specific account. Defensive allocators looking to diversify away from tech will find a 5-star healthcare moat here that warrants a hold or accumulate rating. Global demand for cancer and heart medications is non-cyclical, providing a buffer that most sectors can't offer during an economic downturn. For these conservative profiles, Novartis acts as a robust anchor that prioritizes capital preservation. But for the growth optimizer, this is the wrong asset. If you're looking for the explosive, uncapped upside found in software or AI, you won't find it here. The need to constantly spend billions just to replace expiring revenue puts a firm ceiling on how fast this company can grow. When you aggregate the 5-star ratings for franchise strength, clinical diversification, and cash generation, the overall scorecard lands at a 9.1 out of 10. The ideal entry is on a pullback. Wait for broad market volatility to lower the price, while the core drug sales and pipeline remain healthy. However, exit or reduce your position if you see major clinical failures in the late-stage pipeline or if management cuts their revenue guidance. Investing in Novartis means trusting their R&D engine. As long as they innovate faster than the patents expire, your capital remains on solid ground.